Welcome back, guys. Welcome to lesson 2. This lesson's all about risk and reward. So last lesson we agreed on the basic problem. Cash will lose its value to inflation, and to grow money over decades, you have to invest it. This lesson covers what you sign up for when you do. This bit catches people out. I'm Andrew Daw, so let's get into it. So there's a deal and you can put it in one line. How much you can expect to earn over the long run is tied to how much short-term wobble you can put up with. No wobble, no extra return. That's fixed interest. So like having cash in a bank account. That is how it works. The reason is simple. Investors are people, and people hate watching their money drop. So to hold the riskier stuff, you need to be paying more over time to make it worth their while. So if shares paid the same as cash over decades, same as interest, nobody would put up with that journey. That wobble is the reason the reward exists. The reward element of risk and reward is that wobble. There's two different things that could cause risk when we refer to it, and people often muddle them up. So the first is volatility, and the price goes up and down, and we've talked about that on the previous slide. It feels alarming. It feels like the worst thing in the world. But for a diversified portfolio, over decades, that direction is going to be largely up, right? You can leave it alone and forget about it and come back to it in 5 years, and you can expect it to be up. There might be circumstances where it's not, but you can expect it to be up. The second is permanent loss. Now, if you put all your money in one company and it does not come back, you've lost it all. That company might have gone bust. You've done a concentrated bet on a single stock. This is the one to worry about. This is risk that you are putting on yourself, and for no reason whatsoever, because it has a known fix. It's diversification. We don't keep all our eggs in one basket, and we'll cover this topic later. What does bumpy ride look like in terms of real money? For instance, global shares. A normal year, you might have swings and roundabouts of about 15% up and down. So you might have 1 year, 1 month they're 15% down, next month they're 15% up, and that's fairly standard throughout a year. A normal year. It's not a great year, but it's not out of this world. A bad year, every decade or so, every year, 8 years I think is the average. You see a fall of about 30% over a few months, and people start to panic. People think this is end of the world situation, and it's never happened again, and it's going to change the economy as we see it. Not the case. They almost always recover. A proper crash, so this is typically like once generation. This is around 50%. You might see a 50% crash. Now, the ones that I can think of here are like 2008, the dot-com bust, and 1973. So what happens after each one? Well, recovery. Every fall in modern market history has been followed by a new high, sometimes within a year, sometimes within 5. Knowing that in advance is what keeps you in your seat when the next one arrives, and make sure that you don't panic, don't sell, because the only thing you've done when you sell is lock in that loss. You've got no chance to win it back. So now we look at time, right? Because time changes what the word risky actually means in terms of investing. Over 1 year, you've got roughly a 30% chance the market is down by the end of that 12-month period. Over 10 years, it's about 5%. So 1 in 20 10-year gaps is the market down. Over 20 years, historically, 0. There has not been a single 20-year stretch in modern history where a diversified global stock portfolio has lost money in real terms. Now, for the 10-year one, you have to be uber unlucky. You have to be really unlucky to have felt that. I can't even calculate the odds to be that unlucky over a 20-year period. It's the same asset, it's still stocks, it's still shares, same volatility, same short-term volatility, different time frame. And that has caused a whole different beast, a whole different animal. The past does not guarantee the future. The past is consistent enough that it should shape how you think about risk. If your money is for 10 years or 20 years away, the year-to-year wobble is not a problem. The month-to-month wobble is not a problem. Even the odd crash isn't a problem. Focus on with a long-term view, and you'll fit into that 20-year gap, when you'll fit into the 1-year gap. So we've got a risk and reward ladder here, and we've framed it lowest to highest. So cash has a historically tiny return. It's historically stable, but it will lose its value to inflation. We have talked about that in lesson 1. Government bonds, on the other hand, small bump above cash because they're not deemed risky. They're deemed as risk-free assets because the government won't default on that loan. But there is some mild wobbles to it. The corporate bonds are a bit more interest because they're a bit more risky, but they're less risky than if you held shares in the same company, because the company has to still be around to pay you back, but you're higher on the priority list. Property historically has provided a above inflation return over the long run, but there's a bit more risk that comes with it in the sense it's tied to the local supply, the local demand, and the local rates. And you can't just pick up a house and sell it somewhere else. It's hard to sell in a hurry. It's not a liquid asset. Global shares have the highest long run real return. So the highest long term investing is done in a shares portfolio because it gives you the highest margin over inflation. But it's affected by the biggest swings. We see the biggest downturns in stocks and shares that we don't see in cash. None of these are historically good or bad. Each one has a different job. If you need your cash to be very liquid and you need it for a short-term purpose, then you need to have your money in cash. The skill is matching the money to the job it has to do. So if you need retirement, if you're 20 years old and you're planning retirement, you're not going to look at holding it all in cash because that's just mental. Put it in stocks and shares. So here's 2 questions about risk that people tend to treat as one. Question 1 is your attitude towards risk. It's the emotional side. How comfortable would you feel watching that number drop? Because some people lose sleep over a 5% dip. Others sleep like a baby. Answer honestly and not how you would like to be, because basically everyone knows the more risk you take, the higher your returns are over the long term. But if you can't stomach that return, then you're not going to be in it for long term. Question 2, your capacity for loss. This is the mathematical side. It's the factual binary number that will come out the other side. How much can you afford to lose without it changing your life? Do you depend on the income that comes from stocks and shares? Do you depend on your other assets, or do you have a long time frame to wait out crashes? The capacity tends to be attitude, in the sense that if you cannot afford a loss, the upside is not worth chasing no matter how brave you are on that day. But both questions matter, and we need to treat them separately. So here's 2 mismatches I come across all the time. Both expensive, both come at a huge cost to yourself. First, you've got the long-term money sitting in cash because the falls, the ups and downs, feel scary. It feels safe to keep it in cash, but we lose it to inflation every year, and we've shown that in lesson 1, sorry. The biggest unforced error in personal finance is keeping your long-term money in cash. But you don't see it. The cost is invisible. You don't notice it, and that's why people keep making it. That's why it's such a massive trap. Second, we've got short-term money tied up in volatile investments. So if you need money for a deposit for a car, for instance, or a house, and you might need it in the next year or quarter, and it's sitting in shares and the market dips, you've just lost a third of your deposit. And to actually make that purchase, you have to crystallize that loss. You have to lock in that loss. They're opposite mistakes, but they come from the same root cause, which is not understanding what your money is for and not being aware of the risk you're taking when you put it into each asset. So there's 4 habits you could do to improve your personal finance. None of them require you to be a brain surgeon. None of them are uber clever. 1, match the risk to the time frame. Short-term money stays in cash. Long-term money goes into growth assets. You don't mix that up. 2, diversify. You can diversify across companies. You can diversify across countries. You can diversify across asset classes. It removes the permanent loss risk and smooths the wobble, smooths that volatility. 3, drip feed. Monthly contributions take timing off the table, market timing off the table. You can't time the market. Don't kid yourself. Don't think that you found a secret that no one else can see. You can't time the market. You're buying price averages, and that average will be going up over the years. That's fine. 4, have a plan. Decide now what you would do if your long-term money has a 30% fall. Write it down, and when it happens, look at that piece of paper and go, okay, I've planned for this. I know what's going to happen. I will respond by not panicking. Here's 3 rules for you. And if you forget everything else, remember these. 1, without the short-term bumps, without that volatility, there's no returns. Anyone promising high returns with no risk is selling you a dream. The deal is the deal, and live with it. 2, time changes the picture. Time changes the risk. A loss feels permanent if you need to crystallize it inside a year. Over a decade, it usually is not. Hold long enough and odds tilt in your favor. And that's all this game. It's a game of odds. 3, match the money to the job. Short-term cash and savings, long-term wealth and investments. That mismatch is what hurts. Next lesson is all about compounding in time, and that is the most powerful idea in money, and it shows you why investing is so critical. And I'll see you over there.